Ladies and gentlemen, good day and welcome to the Infibeam Avenues Q4 FY21 earnings conference call hosted by KR Choksey Research. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Parvati Rai. Thank you, and over to you, ma'am.
Thank you, Stephen. Good evening, everyone. On behalf of KR Choksey Research, we welcome you all for the Q4 FY21 earnings conference call of Infibeam Avenues Limited. I take this opportunity to welcome the management of Infibeam Avenues, represented by Mr. Vishal Mehta, Managing Director, Mr. Vishwas Patel, Executive Director, Founder and CEO of the Payments Business, Mr. R. Srikanth, President, Mr. Hiren Padhya, Chief Financial Officer. We begin the call with a brief overview of the company by the management, followed by the Q&A. I now hand over the call to Mr. Vishal Mehta for his opening remarks. Thank you, and over to you, sir.
Thanks, Parvati. Good afternoon to all of you, and welcome to the quarterly earnings call of Infibeam Avenues Limited. Today we've got an exciting agenda. We would like to discuss with you an overview of the company, the industry, and the payment space. We'd like to go over the financials, and eventually we'll end up talking about some business outlooks and then answer questions. I'll hand over the call now to Srikanth, who's the president of the company, to walk you through the journey. Srikanth, all yours.
Yeah. Thank you, Vishal. Good evening to all of you. I hope every one of you and your family members are safe, and I wish good health to all of you. It is my pleasure to present the standalone and consolidated accounts of the company today. I'd like to spend 5 minutes on the industry and then take you through the operational and financial performance. Please refer slide number 4. The choices available to the consumer, as you know, for payment options fall under 3 categories. One is credit options, debit options, and third one is cash. Credit options largely include card-based payment transactions through Visa, MasterCard, and Amex, etc. Debit options include, the bank accounts and wallets. If you observe that the bank accounts, majority of the inventions and innovations are really taking place in India, isn't around actually debiting the bank account. This is primarily because India is largely a debit economy, unlike most parts of the world where credit options are widely used. While digital transactions have increased manifold in India over the last 5 years, cash continues to remain the king, and non-cash transactions are still very low in India. So it's a great opportunity for a company like Infibeam. Demonetization was the first boost for the growth of digital payments in India. COVID has been another catalyst for the growth of the industry. Referring various institutional research, we observed that there are only about 150 to 175 million digital users in the country, and about 15 to 18% of the payments are only digital. This provides a very, very strong headroom for growth for a company like Infibeam. Referring to slide number 5, high-level committee appointed by Reserve Bank of India found that per capita digital transactions per annum during the year FY 2018 in the country was only 22.4 compared to 34 in Indonesia, 79 in South Africa, 148 in Brazil, and as high as 782 in Singapore. Since 2018, per capita transactions per annum has grown only to about 30 in FY21 based on RBI payment system indicated data. We believe India has kicked off growth in this sector, and we'll see more merchants and consumers coming online. Structural and secular trends are driving digital payments market growth, resulting in the exceptional momentum in payment business in India. Consumers and business and banks, governments are all adopting digital mode for business, and digital transactions have increased by 3-4x in the last 5 years, growing at 5-year CAGR over 50%. Various research indicates that the opportunity in payment sectors in India to cross $1 trillion in the next 3 to 5 years time frame, and P2M market size to reach $500 billion due to very strong tailwinds, and emerging industries like online groceries, edtech, medtech, tech companies, and many more that will join the future, including the e-governance. The number of industries 10 years ago vis-a-vis today having digital business model and accepting payments online will give you a perspective of how much industry has really expanded. From only having railway ticket booking online and airline bookings back then in retail and e-commerce, ride hailings, restaurants, groceries, entertainments, newspapers, subscriptions, online education, bill payments, insurance, taxes, and the list goes on and on and on. The next 10 years could see many more industries and services coming online where the payment gateway by default will have a natural growth. And with the low penetrations in India, government's vision to make India a less cash economy, as well as support from Reserve Bank of India, is a positive for the industry. Specifically talking about the opportunities in the payment gateway space in slide number 5, payment market will grow 40% CAGR from the estimated $80 billion in FY 2021 to an estimated $307 by FY 2025, as estimated by Bank of Global Research. Current low penetrations and sticky base will aid growth for established payment gateways and for those who can also offer various value-added services. We will touch upon this in a moment. In fourth quadrant, you will see in the same slide, the payment gateway is the most lucrative market for growth. I just mentioned earlier about how digital industry has expanded in the last 10 years. In the next 5 years, I would say transacting users will increase to 400 million from 160 million users, and an additional 10 million merchants will go potentially online. There are staggering 68% of 60 million MSMEs that are still offline, while 30% of Indian MSMEs will soon push themselves up to transact digitally, compared to the active 2-3% today, as they see more growth and success through the digital model. Based on the ongoing growth and expanding addressable market over the last few years, we believe there is a greater degree of opportunities and many areas within the payments that we can now address given our growing merchants clientele across our fintech platforms. Through slide number 12 and 13 under the business overview section, let me explain our business strategies and plans to capture growth in the digital space. Slide number 12 provides a snapshot of multiple growth engines we have under 2 core business, namely payments and platforms. This is our stronghold. We are a full stack payments company offering various solutions under the payments, covering payment acceptance, bill payments, payment issuance, new business offering like new banking, domestic remittances, and assisted commerce. And we also offer international remittances through our investee company. We also offer e-commerce marketplace platform for large enterprise planning to launch e-commerce at a massive scale. Platforms and payments combination is a proven model globally, and there are very few examples of such companies in the US and China and Japan and many parts of the world. Internet giants are also entering payment space. World largest social media company, world largest search engine company, world largest e-commerce companies, etc., are entering payment space. Our strategy behind building a broader portfolio or multiple sources of revenue generation is explained in slide number 13, where I would like to spend few more minutes. Please see merchant sourcing platforms in part in green. Through our sourcing platforms, namely CC Avenue, PG solutions, GEM platform, government e-marketplace platforms, bill payments platforms, which is our bill avenue platforms, hospitality platforms, which is our res avenue platforms. We have built a strong pipeline of sourcing merchants. Bank alliances also is a strong merchant sourcing channel for us. Over 2.5 million merchants are integrated across our fintech platforms. Every day, on an average, 2,000 new merchants got registered across our platforms in financial year 21. In the last 20 years of offering our core payments and e-commerce platforms, these businesses have been our cash cow and continue to generate positive cash flow for us. We have been consistently profitable. We have also expanded our flagship business brands CC Avenue PG, e-commerce SaaS platforms, res avenue platforms into international markets, and more expansion is underway, where we will build a strong pipeline of merchants in future in the international markets as well. This is one of our growth drivers for the company. With this large merchant base and an understanding of our business that we have built such a long time, it's time we focused on issuing side of our payments, that is lending business. There are various formats of lending that we will get into. The most riskless form of lending is by way of express settlement, and the same was launched by us in September 2020. We have publicly articulated this. We are currently at an annual run rate of $100 million through express settlement of merchant funds. We want to expand this to $200 million by next year and reach about 10% of our processing in India in the next 3 to 5 years. We process payments for roughly 300 crore on an average on a daily basis in Q4 2021. And we have guided this as a part of business outlook in our earnings release. Our next lending model would be to start offering credit cards to SMEs and corporates and business loans once partnership with the lending ecosystem players and integrations are completed. Presently, this work is actually work in progress. As mentioned earlier, we have large merchant base and we have an existing relationship with most of the big merchants in India. This will reduce our go-to-market timings and reduce our marketing and customer acquisition cost. One more important strategy to understand here is that in our e-commerce marketplace platform business, we are working with 2 of the 4 major e-commerce enterprise in the country. Namely, one is government enterprise and another one is large private enterprise in the country. Unlike typical e-commerce model, where making profits may still be a dream even for big companies, we have a sustainable, profitable model. Plus, we have the ability to expand our scope of offerings from pure e-commerce platform to payment services, including lending. And that is one of the parts of our next phase of growth. So, the long-term takeaway from here is sourcing platform will continue to generate strong merchant pipeline for us, and we will continue offering them our core services, explore partnerships with the large enterprises like the one with Government e-Marketplace, GEM, and Reliance-owned Geo Platforms Limited, and build partnerships with financial institutions globally for payments acceptance as well as acquirer payments and CPGS business, that is CC Avenue Payment Gateway Services business, and keeping generating profits and cash flows into the company. To push growth further, we will expand and increase the contribution from the lending portfolio and expand our business internationally. This will improve operational performance and improve cash flows, which we can use to grow faster. Just to let you guys know that our business model is such that the costs do not increase proportionately with the increase in revenues. And this is an advantage of platform-based companies. So in other words, cost is not linear actually to the revenue which we are generating. And revenues are all based on the transaction-based models. Now, let me take you through the business and organization developments in the last financial year. These developments are part of our strategy that I just mentioned. Please refer slide number 15. We signed a very prestigious contract with Reliance-owned Jio Platforms Limited and its affiliates somewhere in end of September 2020 last year, as we have publicly articulated, to license, customize, maintain, and access IAL's enterprise e-commerce platform and payment platforms for their internal business use. I'm happy to share that JioMart went live on our platforms in March this year. The base platform is the same as government e-marketplace platform, but it got customized for Jio's environment. As part of overall contract, we will also offer payment solutions to Jio Platforms Limited. We have already contracted with JPL to offer our bank-grade CPGS platforms. Please note that Jio is not just another customer. Jio is a market in itself, and there are various partnerships that we are exploring with the company. One such partnership is the consortium formed with Jio and Jio's business and financial partners, namely Google and Facebook, to apply for retail payment license or payment network license from Reserve Bank of India. At that right time, we will share more details on this partnership and other developments. Under our payment business, we signed a definitive agreement with one of the world's top banks, JP Morgan Chase, for its India business to offer Infibeam's flagship payment platform, CC Avenue, for processing transactions of its enterprise clients in India. Our entire portfolio of 200 plus payment options is integrated with JPMC in India. This relationship is particularly helpful, keeping in mind our plans to expand in the US. In financial year 2021, we announced launch of 2 business under the payment segment. These are all new business offering which we announced. First is CPGS business, which is CC Avenue Payment Gateway Services business. Traditionally, our focus has been on merchants within the payment processing. As a part of making banks our customers, where we can process larger volumes of payments irrespective of any payment gateway, we extend our scope of our payment platforms to do backward integration in acquiring business by launching Acquirer Processor Services called CPGS or CC Avenue Payment Gateway Services. We launched this in Oman around September last year, as we have publicly announced. We tied up with 2 of the largest banks in Oman, namely Bank of Muscat and Bank of Dhofar, to gain roughly 90% of the market share of processing online cards in Oman. And I just mentioned 2 minutes ago that the same platform has been given to Jio Platforms as well. We manage the entire technology from India. We will expand these services globally, starting from GCC region, and we will also partner with some banks in India. With this, we are now present on both sides of payment acquiring transactions, namely A, front-end PG with 200 plus payment options, and a bank-grade global back-end card processor. And in this CPGS business, banks are our ultimate customers. The second new business which we announced to enter into was neo banking and lending. For this, we acquired a company last March-April timeframe, a company called CardPay Technologies based out of Bengaluru. IAL, a large number of merchants portfolio, over 2.5 million, and adding 2,000 plus every day are potential customers for offering lending services. In the lending space, we have already started express settlement, as I was telling in the beginning of this call, which I explained actually earlier. Later, we will offer cards and business loans to SMEs and corporates. So the whole of FY21, we are focused on building strength and resilience in the business. We have taken steps to build a sustainable business model, evident from the developments I enumerated. We have created a very strong moat around our business. We are differentiated not only by core payments and e-commerce marketplace platform that we have developed over the years, but also by the possibilities that we can create with our portfolio of offerings to complement our existing core business. To unlock value of our shareholders, and focus on our payments and platform business, we had announced demerger and simultaneously listing some of our non-core business. Accordingly, NCLT has approved the demerger, and after complying with the listing norms, both the entities, Suvidha Infoserve and DRC Systems, were listed on the stock exchange in March 2021. Additionally, we rewarded our shareholders with 1:1 bonus shares in December 2020 as a part of our corporate action. Let me now take you through the operational and financial performance of IIL in FY21. Please refer slide number 16. The three charts reveal the operational performance of our business at large. Payment processing has increased 55% Y-on-Y to approximately 1,780 crores in FY21. Monthly payment processing in Q4 averaged about 10,800 crore from little over 6,000 crore in the same period last year. Thus, we are at the annual run rate of processing 1.2 to 1.3 lakh crore, or about $18 billion in payments in FY22. And that's just in India and UAE. Soon we'll also see an international markets like Saudi and a few of the GCC countries and USA adding to this growth shortly. Merchant registrations continue to be robust, and our alliance partnerships continue to deepen, opening up more business for us. Retail contributions continues to dominate in terms of number of merchants on the PG platforms. Education, utility, grocery, IT are among the larger contributors in FY21. B2B registration tripled and utility tripled in B2B registration tripled and utility doubled in Q4 vis-a-vis Q3 sequentially. Basically, merchant registrations in FY21 has been the best we have seen in our history at 300 plus registration on an average every day, and it seems like we are at the digital growth from here, heart of digital growth from here. Talking about bill payments business through our Bill Avenue platform, the average daily volume growth is almost about 7x in March 21 compared to April 20. Bill payments volume in FY21 is up 226% year on year to 25 million, and it is up 40% sequentially. We have seen month-on-month growth in volumes the whole of FY21. We have 93% market share of total 19,633 billers on BBPS as of 31st March 2021. We are a TSP to majority billers. As more billers categories open up on the BBPS, we will onboard more billers on a consistent basis. Simultaneously, we continue to build the agent network across the country, as bill payment is still largely a cash offer in India. We have grown our agent networks from 600,000 last year to nearly 675,000 as of now. Number of agents institutions have increased from 175 last year to the level of 250 at the end of financial year 2021. The industry processed about 2 million bills in March 21, about 1 million a day. Our aim is to process 1 million bills daily in the next 3 to 5 years. Lastly, the performance of government e-marketplace, GEM, our largest and our significant customers in e-commerce marketplace platform besides few other customers. GEM achieved cumulative GMV of 1 lakh crore in March 2021. Since inception in August 2016, more than 90% of GEM's GMV has been achieved after GEM went live with us. This is an exclusive contract for almost 6 years, as you all know. We went live in January 2018. We won the contract in August 2017. Within a period of 5 months, like in January 2018, we earn a very high single-digit basis point on a value of the procurements. Again, this business model is linked to the transaction revenue. As you can see from the chart, GEM GMV in FY21 was 50,000 crores. Government is targeting to double the procurement in FY22 to 1 lakh crore, which is about $13.5 billion, with the integration of railways and addition of more government bodies, as well as adding more merchants on the platforms to offer wider variety of products and services on the platform. Last year, we signed a definitive agreement, as you all know, with Reliance-owned Jio Platforms Limited to offer the same platform for JioMart customized to its requirements. JioMart is now live on our platform and is integrated with various 3P platforms for 10x value propositions and 10x consumers experience. We are proud to state that we are now connected with 2 of the 4 largest e-commerce enterprises in the country. GEM and Jio together opens up huge opportunity for us to offer our payment solutions in the payment space. To summarize this slide, both payments and platform business have shown excellent performance in FY21 despite the ongoing pandemic. We have built a strong pipeline of merchants from whom we expect a good business going forward as they grow their business through the digital mode. With this, let me move on to my financial performance. However, before that, it is very important to really thank the entire leadership of Infibeam Avenues and also employees of the Infibeam Avenues and the customers and merchants who supported us actually through this journey throughout the period consistently, and thanks for all their untiring efforts. Let me just go to the revenue model. This will be made clear from slide number 17 and slide number 18. Please refer slide number 17, which is Infibeam's revenue model. Infibeam revenue comes from 2 business segments, payments and platforms. Payment business contributes 78% of our gross revenues, including revenue from our subsidiary companies, co-payments, and 22% comes from our platform business. In payment business, approximately 95% of the revenues are generated based on transaction-based revenues, and rest being setup fee, maintenance fee, etc. Platform revenues is largely license, subscriptions, maintenance, development, setup fee, value-added services, and portion as a transaction-based revenues from GEM platforms. Thus, IaaS revenue can also be classified as a transaction-based revenue model plus non-transaction-based revenue model. Refer the blue boxes in the middle of the row. And derivations of the transaction-based revenues are explained in the 3rd row of the same slide. Our operating expenses are predominantly a pass-through cost in the payment business. As you all know, I have articulated time and again actually through various calls that our members, consortium members, partners are issuing banks and network players and so on. So we have to really provide the pass-through cost actually for them. So therefore, our operating expenses are predominantly pass-through costs in the payment business. Let me explain this through slide number 18, where you will understand the payments revenue model and learn about the ecosystems of players in the digital payment industry. In payment gateway business, we offer 200 plus payment options. In a single integration to the merchants under the various debits and credit cards payment categories, namely debit cards and credit cards and net banking, wallets, EMI, UPIs, pay later, etc. Each category has a different take rates and involves cost to the companies on the top, which we add our margin and give it to the merchants as a bundle. We have taken here the examples of credit card options used by the consumers while making the payments for online purchases in the merchant's website or merchant app to help you to understand the revenue models and value chains in the digital payment business. As you can see pictorial presentations, 2% is being charged to the merchants and significant portion is typically shared with the issuing banks, acquiring banks and the payment network, and therefore they are the main ecosystem player in the cost credit card payment options. Credit options, which also includes the financing costs and the risk of non-payments, will have a different MDR vis-a-vis the debit options, which directly debits your bank accounts and so on. For certain options where there are regulatory guidelines like RuPay debit cards and UPIs and QR codes, hence, we earn differential rates on every different payment options depending on the payment options used by the consumers. Rates are also differs depending on the size of the merchants and depending on the industry. However, international markets are a bit different. It goes without saying that their take rates are higher. The rates in the UAE, for example, are higher compared to India. There are very few payment options in UAE, about 15, unlike 200 plus in India. And credit cards continue to larger pie vis-a-vis like India. And India is culturally a debit economy. Indians typically actually spend what they have rather than using the credits. So in India, we see larger usage of debit options, also evident from the number of debit cards in the country and net banking and UPI transactions compared to credit cards. Hence, take rates are relatively lower in India. I hope all of you would have got a bit of clear understanding of our revenue models. With this, I proceed to discuss financial performance of the company in FY21, presented in slide number 19. Transaction processed value has increased 27% sequentially to 50,391 crore. For the full year of FY21, the TPV was 1,39,405 crore, which is about $19.1 billion, and it is up 59% compared to FY20. So in nutshell, 27% sequential growth and 59% year-on-year growth. And this is exactly the reason why we have shown an impressive performance in Q4. Average monthly TPV in Q4 was approximately 17,000 crores. With this run rate, we will be able to process TPV of 2 trillion rupees, that is about $28 billion in FY22, and that is pretty much our current run rate actually. Go Payments TPV in Q4 was about up 30% sequentially and 115% year-on-year. Government e-marketplace GEM cumulative GMV crossed 1 lakh crore, which is $14.1 billion in FY21 cumulatively. Daily GMV as per GEM publication was close to 250 crore, 230 to 250 crore in March 21, vis-a-vis 100 crore in March 20. Bill payments grew through our Bill Avenue platform month on month in FY21 and continues to show a stronger volume. FASTag is now live with us and we expect to see strong volumes going forward. With that, gross revenue for the full year, FY21, was up 3% to 676 crore on a like-to-base basis. Gross revenue in Q4 fell 12% to 201 crore from 228 crore despite growth in TPV, primarily because of the second wave of COVID as well. Q4 drop in gross revenue was impacted by the change in the industry and pricing mix. Flat fee-based utility and education sector contribution increased, while contribution from percentage-based retail transactions in aviation, travel, tourism, hospitality, entertainment have reduced, leading to a lower gross take rate and hence drop in the net take rates. And I'm sure the moment the COVID situation improves, all these sectors where we are conventionally very, very strong, like aviation, travel, tourism, hospitality, entertainment, will again actually reboost and, we will have a different take rates altogether. But we structured the pricing and payment business for capturing market opportunity during the current year. Our net take rates improved 30% sequentially to 6.7 bps from 5.2 bps in Q3. This led to increase in transaction-based net revenues and hence our net revenue, which increased sequentially in Q4 by 8% to 66 crore from the level of 61 crore in Q3. EBITDA fell marginally 7% sequentially in Q4 to 37 crore, but was up 5% in Q4 to Q4 last year. Adjusted EBITDA as a percentage of net revenue in Q4 was 56% compared to 65 in Q3 and 58% last year. For full year FY21 EBITDA, which is actually a very important factor for our growth and for our guidance and so on, it is 61% of the net revenue from the level of 60% in FY20, and this is what we are guiding for the current year to 62% for the current year. PAT in Q4 was up 148% sequentially to 32 crore and up 30% Y on Y. PAT as a percentage of the net revenue was 48% in Q4 compared to 21% in Q3. For FY21 PAT as a percentage of the net revenue was 30% vis-a-vis in FY20. The drop in PAT, as you all know, in FY21 is on account of the entire year as a whole, lower share of profits from associates and excluding which the growth would have been 34%. Fundamentally, we have grown actually on the PAT. We are consistently converting the EBITDA into a free cash, and our cash and cash equivalents have gone up significantly to 178 crore from the level of 99 crore in the beginning of the year. In the following months, as the effects of pandemic slows, we expect the pricing mix to change, thus improving the net take rates and performance. Going into FY22 and further, our payment gateway business in India and government e-marketplace GEM will continue to grow naturally. Payment growth will be driven by merchants, business coming online, more sectors adopting to digital mode of doing business, new sectors with unique business model opening up with the digital model. Government e-marketplace will keep growing as the government is determined to build an online procurement model and thus integrating various government bodies' procurement into GEM, like what they have done during last year, Railways Department. Apart from these, our additional revenues and margin drivers include, first, payment expansions internationally. We have been articulating this as one of the growth drivers for the company on the top line and also for the bottom line. And we plan to have this footprint in more than 10 countries in the next 2 to 3 years. UAE or GCC, Saudi, Oman is already in place, and now US and the US is also already launched. And we will be aggressive on Saudi and a few other countries actually in the next 2 to 3 years time frame. Second, new business announced in FY21, namely CC Avenue Payment Gateway Services, branded as CPGS, new banking, cards, and lending. Third driver is bill payments through our Bill Avenue platforms. Growth in remittances and assisted commerce is seeing a multiple jumps in this business, where its monthly payments of GTV crossed actually 3x in March 21 compared to March 20. And this is an encouraging factor for us to really have a growth in the remittances and assisted commerce. And of course, lastly, partnership with Jio platforms and JPMC Bank in India. And on the profit driver growth, needless to say that the express settlement is one of the drivers. Now, please turn on to slide number 20. We have a very strong balance sheet. As we generate cash quarter on quarter and year on year, we have this advantage due to our platform-based business model that allows us to scale faster compared to cost. The company's cash has increased, as I was saying earlier, to 178 crore as on 31st March 2021, which is 99 crore as on 31st March 2020. It's up about 80%. In absolute volume terms, it's up actually 79 crore. We're virtually a debt-free company with very negligible debt of 20 crore of term debt at a very concessional rate of interest, and therefore we are net cash positive. We are a net debt-free company. Our EBITDA to cash conversion has remained over 100% consistently for many years. And time and again, I have been articulating to the investors, and this is actually a fact. Fourth, cash from operations before working capital in FY21 was 148 crore. This is the cash generated. This has been consistently positive and strong for the last many years. By virtue of our business model, in payment business, we have a negative working capital as we receive money in first and settle with the merchants after T+1, T+3, T+5, T+7, as case may be. Working capital thus includes settlement money of merchants lying with us on the closing date of the balance sheet. Hence, For us, cash from operations before working capital is the right measure. Otherwise, the cash from operations is still higher in FY21 at 168 crore before tax. And we don't take merchant money actually into our system. Free cash flow has been consistently positive. Free cash flow in FY21 was 66 crore vis-a-vis 104 crore in FY20. On slide number 21, we present the outlook of Infibeam. We expect with our success, with our experience, with our run rate of our business, with our run rate actually on our transaction processing, both on payments and platform, we expect to increase the transaction processing value to $100 billion in 3 to 5 years time frame from FY22 run rate of 22 billion as we speak. EBITDA as a percentage of net revenue to improve from the present level of 61% to the level of 65% in FY22. Increase secured lending under the neo banking from the present level of $100 million to the proposed level of $200 million in FY22. With this, I hand over the floor back to the moderator to open it up for question and answer session. And thank you all for your time, and thank you all for being patient. Moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mayank Babla from Dalal & Broacha. Please go ahead.
Thank you for taking my question. My two questions were basically on EBIT. One was on EBITDA. So what was the reason for the softness quarter on quarter? And second, in the free cash flow, why was it so lower at 66 crores versus 104 crores last year? That's all from my side.
Our EBITDA margin, if you would have really seen actually on the net revenue, it was in the Q1 of FY21, it was 61%, Q2 was 62%, Q3 was 65%, and Q4 was actually 56%. Primarily that, we have to rationalize our pricing, in order to cap actually more market opportunities. And second important reason is that, in terms of some of the sectors which carries actually fixed fee model, like education sectors and utility sectors and so on. So that is also another reason. And third one is that, there are the flagship sectors which we are having, like entertainment, travel, hospitality, aviations, and, these are all the sectors where conventionally we are very, very strong. And in terms of both the gross take rates and net take rates and margins. And because of the COVID situation, the sectors have not been fully open. And as and when we open that, we will be able to really improve our margin. That is the reason why we are saying actually that EBITDA margin for the entire year on net revenue basis to the level of 65%.
Sure. So, and free cash flow?
Hiren, would you like to really answer to this free cash flow question, please?
Hello.
Purvesh and Hiren.
Yes. The free cash flow, I think from the last year, 104 crore to 66 crore is the actual figures. Basically, there's no specific reason for that, but we are just saving in terms of capex last year, and in terms of operations also, we have achieved very good performance in terms of cash flow. So
one important reason is that which I can possibly highlight is that changes in the working capital is one of the important things, because in government e-marketplace business, the DSOs are relatively higher. because the process of making the government payments actually is a little different as per our contractual terms. It is linked to the order closures and so on, and that is also been blocked actually in the changes in the working capital. So that is primarily one of the reasons. Because in our payment business, DSO is negative, but in our government e-marketplace business, DSO is actually always on an average actually around 7 to 8 months time frame.
Okay. Sure, sir. Thank you so much for your time. Good luck for the next year. Thank you.
Yeah, thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Ravi Mehta from Deep Financial. Please go ahead.
Yeah, hi. Thanks for the opportunity. So my first question is pertaining to the take rate. So when I look at slide 19, so probably the lockdown effects were not that felt in Q4 actually. So any specific reason why the take rates have been low and whereas the volumes have been high, which means probably there are volumes happening, but maybe it's all low margin happening. So maybe if you can share some color.
Sure. So the fundamental strategy of the company, Praveen, is that we don't want to lose the market share. And we should not really, if I'm not going to do the business, somebody else are going to do the business. Because at the end of the day, as I was mentioning to you earlier in one of the calls actually previously, that the pricing pressure is not the art, it's a science. It is there every day. So however our platforms are good, however our processing is good, however our operational efficiency is good, however our settlement process is good, however we are having a satisfaction actually before the merchants and so on and so forth, the net effect is that what is actually for the merchants in terms of pricing. So therefore the pricing pressure will always be there actually for the industry, and so be it actually for the company as well. So therefore, while on one side we are a public company, we cannot really bring down the price actually below certain threshold levels and so on. But nevertheless, this pressure is always there. So therefore, this quarter actually we don't want to really, we have to really adopt the rationalized economic pricing in order to capture the market opportunities. That is one thing. Second is that conventionally we were not very strong in education sector. Thanks to COVID, I think education sectors, we are becoming very, very strong. And education sectors, as the volume goes up, it's actually based on the fixed fee model. Same the case with utility bill payments and so on. So therefore, that is also a second reason. And this is basically, these two basic reasons actually, pull down the net take rates. Third important reason is that, as I was telling you, entertainment, travel sectors, aviation sectors, and hospitality sectors, including hotels, have not been open thanks to COVID. So this is our strong foothold actually in terms of our gross take rates and net take rates actually. So from that perspective, once it gets open, you will have a different net take rates altogether. And that is exactly one of the reasons why we are guiding the market actually 65% on net margin in terms of EBITDA actually.
So as things open up, you expect the take rates to go back to FY20 levels as the mix of the merchants improve, is what you are trying to indicate?
We are saying we are going to work on a consistent only one number, which is 65% on net revenue, EBITDA margin. So therefore, I think it will be probably even better than that.
Okay.
Ravi, this is Purvesh. If I could just add to what Srikanth sir just added. There are 2 points to this. One is obviously when these sectors grow, the retail sectors, obviously there will be some change in the pricing mix that you will definitely see. But on the other side, what Srikanth sir was mentioning a couple of minutes back, that we are getting into new businesses. These newer businesses have very little pass-through. The lending business, which is also at 100 million currently, which we expect to take it to 200 million. All these are net take rate accretive, which will overall, as our business grows, will improve the overall take rate. So apart from the natural growth within the payment gateway, these new businesses will also add to the net take rate. So these are our margin drivers.
Let me explain this was here. Let me explain from some layman's perspective. right? If you have seen, the overall transaction process has increased by 27% from last quarter. So from straight 39,000 crores, it's gone up to 50,000 crores plus. So it's a healthy 27% jump in just 3 months, right? And if you look from a layman perspective, the utilities and others in this COVID period where it is work from home and other things have increased. Now, typically utility payments, including education, have a fixed fee. So even if it's a 3 lakh rupee transaction, we are charging 25 rupees or 30 rupees a transaction. It does not go on a percentage-based value. Typically, in all our other businesses where we are very, very strong, like say the airline business, where we power almost 27 airlines, right, from Emirates Airlines to Indigo to Vistara to Gulf Air to Oman Air. Similarly, in hospitality, where we power the entire Taj group of hotels, Oberoi, ITC, Lemon Tree. So all those businesses are severely affected. These are percent-based business. So if you are charging for 1 lakh, we charge them a healthy 2% or something on those lines. So we make 2,000 rupees every transaction. That's the charge. On that, we make certain bips, right? So a percentage bips, this is this thing. So a flat fee business has increased due to COVID, and the percentages business where we are very strong, it's still down. But overall, if you see, the volumes have gone up. So that means a significant intake that we have done on the utility business and on including education and so many other business where it's a flat fee kind of a take rate. So is that understood? So how the business?
Sure.
So once these also open up.
That's why I wanted to ask, because the volumes are actually shorter, but the take rates are low. So that's why the question whether we are focusing on low margin volumes or probably the market was such that we had to do that.
Right.
Yeah.
And just to let you know the data points, actually in FY20, our EBITDA and net revenue was 59.9%. In FY21 as a whole, 60.8%. And we are guiding the market for 65%. So for all practical purpose, that we are in the right pathway.
Sure. And as a strategy, it is fair to understand that you're guiding 65% EBITDA means if you shoot over and above, you would be happy to give it back to the market and capture more volumes.
Can you say it again, please? I couldn't understand.
Oh, sorry. So when you share that the 60.8% margins, you are targeting 65%. Which means if the business is good and mix is much better and you overshoot your targets, you would be happy to give back some benefits back to the market, merchants and all, and garner more volumes. That is how we should understand?
It's a mix of, I would say that, it's a mix of both. Basically that, why we are actually improving the margins is on a threefold account. One is profit driver actually measurement, which we do through our express settlement. Second is the new business offerings of CPGS and new bankings and so on and so forth. Third is our penetrations actually in the overseas market. And fourth is our platform business also. We believe there will be a good traction actually on the platform business in terms of our margin improvements and so on and so forth. And of course, constantly, we monitor the markets, opportunities, and we don't want to lose the opportunities in any manner. So that's a balance we always do in such a way that we don't reduce the numbers below certain threshold, but at the same time we would like to capitalize the market opportunity, and we would like to grow both on TPV, but at the same time actually we balance the margins as well. So I think this kind of exercise which we do on a day in and day out basis through our rate card process and so on. And unlike some of the private companies actually, where this kind of a margin pressures are not there, but being a public company, we are actually coming under the margin pressure actually. Therefore, we are cognizant about this fact and we are adopting this kind of a strategy.
Sure. That's it. And is it possible to share platform business EBITDA margins?
We will share right now we are not sharing it actually, platforms and payments separately. Only at the revenue level we are doing, but not at the margin level because of the competition reasons. But we will definitely share at the right point of time.
Sure, sir. Appreciate it. And one more question I have, if I can squeeze in. So just going by the fintech side, a lot of unlisted players are valued at steep valuations compared to what we are traded at. So is it that they have become much larger, or the technology platform is more disruptive, or any competitive scenario if you can draw where we stand vis-a-vis the evolving fintech scenario?
Right. I think you hit the nail in a very right manner, and that is the pressure point which I, as a professional, going through in the company on a day in on day out basis. That there are private players in the market are not making money, and their net take rates are all actually below the cost, and but still they are getting valued actually maybe several X factors beyond our capabilities and so on, so forth, our valuations and so on. So the point is that public company valuations and private company valuations, the modalities are, as you know, a little different. But I think for all practical purpose, as a management team, as a professional team, as a leadership team, what we are really focusing on our business growth, EBITDA, cash conversion, free cash, cash equivalents actually increase, cost optimization, process improvement, technology investments, overseas actually growth story, new business offerings actually success story. These are all the factors which we are focusing in both on platform business and payment business. So therefore, obviously, the valuation will be, I'm sure at one point of time, you guys will realize the real intrinsic value of the company, which we believe that, it is valued very low. But I'm sure the time factor will prove it that, we are valued actually very low. And the intrinsic value of the company is significantly far superior than compared to rest of the players.
Let me put it the other way. The Vishwas here, the private players that is there are focused just on one solution, right? And everything on the tech part is something which they have more or less adopted from what we have done over the years, and we continuously invest in building that scalability, the tech stack and others, right? Not only but for around the region, right? And also, if you see some of the biggest clients that have boarded in the country are onboarded on our platform, and there's a continuous evolution of innovation and newer technologies that have pushed in so many of the biggest banks in the country adopting us. So it's a matter of take that they undercut in certain prices and so the volume and grow, because that's what's happening in the private space. Second thing is less people taking money there. The top 3 or 4 payment players, including us, are not looking at money. Only 1 or 2 new private guys get that play, because be it in the peer groups, in Naspers, PayU is not picking money. BillDesk has already picked up, and there are 1 or 2 other guys. So it's the newer guys, 1 or 2, and investors also does not have any inroads, will fund these new guys irrespective of how they grow the volumes. So it's a question of business, and it's a question of take rates and other things. If you do below cost, then it's very easy to scale up, right?
Sure, sir. No, so my concern was that probably on the competitive landscape, we score better over them is what I understand.
Yes, we are. So on technology stack also, if you see the wide forums on what we do, just not the PG, where we have the maximum number of options even today in the country, integrated with so many core banking solutions and 1001 features, but also if you see the associated things that we do around it, the entire B2 based platform, the entire extension into the same platforms in 2 different countries. And then if you look at other solutions like BBPS, Bharat Bill Pay, not many of our competitors are doing it, where we've grown now almost 200% in this quarter on the number of bills processed. And if you see so many of our other solutions, right, what we do in the hospitality solutions and our platform business, which is also unique to us, right? And you compare that kind of our company valuation, which we service the newer guys claiming a couple of $1 billion valuation. So even we are at Enigma why our investors don't value it. So it's a question answers you all have to answer more than us.
Yeah, sure. Okay. Thanks. That was it.
If you would have really seen, actually, we have shared a lot more data points actually, on the business. And we by design we want to be very open and transparent actually on the numbers and performance and our strategies to the best interest actually of the company to the benefit of our investors and shareholders. And as Vishwas was mentioning that the platform piece, it's a very, very huge piece, and I can talk for about 10 hours actually on platform piece, what is our success and so on. In fact, through our platform piece, we are scaling up actually on our payment business actually with respect to some of the named accounts and so on. New banking and lending business can really accelerate through that kind of a data. Data is a huge wealth actually for us. And platform business companies like Geo Platforms, Reliance owned Geo Platforms, will not actually risk the entire Geo Mart business actually, with certain unproven systems and so on. So our system is well proven in the market, and the government e-marketplace is actually working so well in the last 4 years. And I think the GeoMart has done all sorts of due diligence, and today we signed the contract on 29th September, and by March, actually within 6 months, the entire target platform actually kept live. It's not a joke. These entire product platforms of, the Amazon competing with big boys actually in India, like Amazons and Flipkarts and so on, that kind of a platform, which we have gone on live with the 1Ps and 3Ps and enabling actually GeoMart in terms of our payment business and, scaling up actually along with that, build a relationship and, we're doing all sorts of other strategic actions actually along with the Reliance is not a joke. All these things are possible only with our platform business. And fundamentally, business model is also very lucrative to us. On one side, it is on the GEM business model is all the more lucrative. And Geo side, actually, the business model is lucrative either on a direct basis and also on an indirect basis. So therefore, with that, we consider these two business verticals, payments and platforms, are our two hearts to our engines, and invariably working on a transaction revenue model. And I think with a light asset model, and we are not capital intensive industries and so on and so forth. And our cost is not linear to services. And the cost is linear, the cost is basically headcount, whatever the headcount which we are having about 5 years ago, same headcount only we are having it actually right now. So therefore, for all practical purposes, we are profitable. We are making a sustainable growth.
Yeah, and to add to this, with less than 500 people in the payments biz and in the platform base around 700, 800, so it's around 1,200 people, we are able to generate a lakh crore in GEM, more than a lakh crore in CC Avenue, plus grow internationally and others. So if you see it, the growth is not dependent on the number of people. Second thing, if you see the payment stack, right from the platforms to the payment stack we have done, and we are powering the banks, we are going directly to the merchant acquisitions, we are doing bill payments, and now with a new this thing with the RBI, we are going to make a NUE similar to a MasterCard Visa, and not only go against NPCI head-on in the India market, but also globally. So if you see the whole scape that where we're going to have a card company on the likes of Visa, Master, if you look at the whole payment stack, if you look at the whole platform business, and if you look at a million merchants on GEM, a million merchants on our payment stack, everything. So, and it's growing wonderfully in multiple markets. So we're already the number 2 players in UAE in 3-4 years short time. So everybody right from at the top at Burj Khalifa, if you want to book your tickets to go to the top at the world's tallest building, you're going to CC Avenue, to all the top builders out there from Nakshil to Damac to Imar, all those maintenance of all those properties to so many utilities. So similarly in Saudi also, we just started out there, and we'll give you good news on many other markets that we are getting in. So in US also, we are almost there. So going forward, entire thing is strategy is in place. That is it.
Thank you. The next question is from the line of Devin from KR Choksey. Please go ahead.
Hi, everyone. Good afternoon. I think I was interestingly listening to the response given by Vishwas Bhai and I think Srikanth also on the subject of this particular volume of business and I think the amount of revenue, plus the, I think, issues which are related to the private players who are taking away the larger share by way of, I think, competing with established companies. Now, on one side, I think this particular situation cannot easily be changed because I think they also have to record, I think, their business because their investors are funding them. And because they are funding them, so they are funding them to burn cash. Till the time I think they can survive, I think they will. In the interim period, I think we will add into our portfolio additional revenue coming in from some of the value-added products, which I just started talking about. Probably, I think that will be the pressure that you would continue to face. Now, the twofold question here. On one side, suppose if they end up getting or attracting the free money, as I would like to term it as, or I think increasing their volume or their valuation, etc. What stops us, I think, from approaching such kind of players to attract that free money and I think take away market share from others and record, I think, higher amount of processing value? That is one point. And suppose if that has to happen, then which are the areas or which are the, I think, the payment areas, I think, from where I think you can take over that kind of a volume? If you can throw that light on this, probably I think, at least I think this is the first question. Maybe I come to the second question after this question later.
So, Vishwas here. I'll take on the first question here. Now, there are two ways to look at it. Take easy money, free money as you quoted, and go after existing market share and, try to get in the valuation that is there and burn money, right? So that's one part of looking at it. The other way we look at it is that today the Indian digital market is only 15%, right? 85% is still cash. 29 lakh crores of cash is still there. There are so many verticals that are still not digitized, in a sense that if you see the entire medical hospitality payments, the medical hospital payments is not digitized. If you see, we have almost 12 million schools in the country. How many of them are accepting online? So there's a huge market and there's a huge penetration. So either you focus, take money and try to take part of that existing 15%, or you look at the 85%. So our company has very, very clearly focused on it. That's where you see the number of index on the new merchants going online with us. If you see our quarter-on-quarter numbers, the number of new uptakes that is there, and that is giving us business. If you see the number of sellers that are coming on the GEM platform, now almost crossed more than 1 million. That's a huge onboarding exercise that all we are doing. So there are two ways. Instead of taking money, and we firmly believe that the investor money, this kind of a flow should end shortly, with Paytm also now going into an IPO mode, and a lot of other guys also getting in that IPO mode. Then some sense will prevail for that other burn also. So we need not burn. There is a huge market that needs to, you look at the broader picture. The tailwinds is behind with us. We are with the government's Digital India thing, and there is no significant any headwinds blocking us. So I think we should go all focus on the bigger picture. And anyway, if you've seen, we are still doubling our business quarter on quarter, every year on year. So that perspective, I don't think we need to look at that kind of a grow, burn, and flip kind of a model. We are looking at a more sustainable revenue, more sustainable profit. That's what we are looking at.
Thank you, Vishwas Bhai, for I think putting this point across. And I think I'm happy that I think we are working on the quality of the business. The other point I think which probably comes along, now unlocking situation would start happening, as I think we see relatively better progress on the health of the people, and probably I think with the prevention and the cure both occurring simultaneously in the COVID case, maybe I think we will see opening up of the economy. But some of the impacted sectors which you just mentioned, I think those impacted sectors I think would probably start recording better business, better volume, and so could be I think the numbers I think will get reflected for you. In a given situation like this, considering that, okay, I think the first quarter is a washout quarter, okay, for those sectors. But assuming that I think somewhere it gets little steady and normal in the second, third, fourth quarter, what is the kind of volume that we are talking about for processing? We have already achieved 50,000 crore worth of processing of transactions in this particular quarter. The run rate is already achieved for 2 lakh crore. What is that we are talking about for 21-22 financial year?
So this is Vishal here. If you look historically, we have grown in high double-digit percentages in terms of processing volume. So rather than focusing on a year or a quarter, we've set our own vision and targets to process $100 billion in the next 3 to 4 years. So if you look into our outlook, the run rate, I think we're looking at in terms of FY21, we can process about close to $30 billion in FY21, and we are already in that run rate. We think that a combination of flat fee. If you recollect, we just introduced a flat fee model about 6 to 7 quarters ago, 6-8 quarters ago, and in COVID it's grown, and given the pandemic that hit us again, which is the second wave of the pandemic, the number of transactions in the fixed price model that increased by 2 to 3x just in last quarter alone. So it made up for some amount of processing volume, given the other sectors were down. So we think when the other sectors build up, that it gives us a good momentum. The other thing which is also there is we've got a very large pipeline. We've got some very large strategic accounts. Today we are distributed in processing volume across, as Vishwas said, there are more than 1 million merchants on the platform. We also have some strategic accounts that are very, very large, that potentially can add to the volume. Today, such strategic accounts account for less than 1% of our processing volume. And so when you add such strategic accounts, we believe that it becomes a very interesting opportunity for us. And that is the one that we'll focus on for this year. But as you can tell, the strategic accounts take their own time to actually build up and scale up. And so as a result, short of that, we think that, about close to a 30 billion run rate will be achievable, which is what we're right now.
Yeah, agreed. And Vishwas here, also on the strategic account, if you see the strategy that we are pursuing on every vertical, right? So we already have set on, say, the travel vertical from the airlines, hospitality, hotels, to all the top ones, 2,000 plus hotels, to almost all the bus, to everything. So even if you look at even the marketplace business, right? So we anticipate that in the coming decade, there will be 4 marketplaces that might be dominant in the country, right? So one will be Amazon, the other will be Walmart, Flipkart. The third one will be, of course, the government's own e-market, GEM, what we mentioned about. The GEM is like the monopoly, entire procurement of the central government is moving to that, plus some 15 plus states, right? All procurement is moving there. And last, of course, Jio will come in with their online to offline strategy. So if you see out of the 4, we are strategically invited into the 2 of these marketplaces, be it the GEM and the Jio marketplace platform, which will compete, which includes the platform and payments play in both. So we're working strategically, and I think these strategic accounts will drive a significant volume in the coming quarters.
Thanks. Thank you so much, Vishwas Bhai, Vishal Bhai. I think this gives a lot of clarity. One last question from my side. I think what is the status of NUE, and when exactly it is likely to come up? What kind of change it can bring as far as our strategy is concerned going forward?
So, Vishwas here. So right now we can only state that we have made the application for NUE along with our partners through our subsidiary company, Soham. That is it right now, because it's awaited right now. RBI will take a decision on the license. Post that, if there is any news, then as duty bound, we will inform the board and it will be put up in the public notice.
All right. Thank you so much. Thanks. All the best.
Thank you. The next question is from the line of Shubh Joshi from Pile of Wealth. Please go ahead.
Hello. Hello, sir. Actually, very good evening. My question is that what is the company capex plan in the South America continent, but there is too much opportunity for the businesses, because that I read there is no competitor in the company. That I think that there is much more growth opportunity. But second is that our query that our investors are worried about the company, that we listen some insider trading, some news. So please give me some clarity on this one.
So on the capital expenditure, we are actually always a light asset model company. For platform business, our capital expenditure is hardly anything. And on the payment business, it is possibly less than $1 million. So it will not be that significant. And your second question is actually in the context of I think insider trading or something. I think none of our company is not involved, and none of our promoters company and promoters group and any of our promoters shareholders are involved in any of this kind of stuff, and there are no case actually pending at this point of time. And so we are not party to any other shareholders are potentially actually coming under the purview of this alleged transactions. And we are private to that, and we are a public company, and the company is not involved in any manner.
Actually, sir, third question is, what is the plan of the free cash flow? But because my free cash flow is very important in India, because the company, any company do a capex in India because cost of capital is very high. So that we are much focusing on the free cash flows. Like everything that company will much focus on the free cash flows.
Right. Cash is always king. At the end of the day, we need money actually for our overseas expansions. We need money for our technology investments in terms of the long-term technology investments. So primarily overseas growth drivers and so on. And of course, we need to have strategic investments actually in some of the strategic initiatives of the company within the group. And therefore, we will preserve the cash actually for that besides some of the corporate actions.
Actually, sir, can you explain me the Suvidha that you listed this company? I read about the business, but I did not understand. What is this is your company that you listed at Sunday before. Can you please tell me something about it?
So we are not, Suvidha is a separate listed company, and as a Infibeam management and this is an Infibeam call, we cannot really talk anything about the Suvidha or DRC.
Actually, before it's a part of your business, but the company.
Yeah, this is being under law, under regulation. This is being a separate listed entity. It is not correct on our part to really talk about neither Suvidha nor DRC. So should you have any questions, definitely we can put up that question actually to the Suvidha management and DRC management, and they'll be happy to respond to you.
Okay. Thank you, sir. Thank you, sir. All the best.
Yeah.
Thank you. The next question is from the line of Sri Shankar from InCred. Please go ahead. Mr. Sri Shankar, your line is in talk mode. Kindly go ahead with the question, please.
Sorry, can you hear me?
Yes, sir.
Okay. The key question that I have is a couple of questions. The first and foremost, if I look at it, till 2012, you literally had a monopoly in the payment business to that extent. If I may look at it, your competitors, Razorpay, PayU, and some of these guys have come into the market, and I think PayPal has already left this market also, if I'm not mistaken. So, severe amount of pricing pressure, competition that we have seen. Is that pricing pressure still in existence, or is that the reason why the pressure that is being seen on your entire revenue?
I have already, Vishwas, we have
already talked about it.
Yeah, so we already talked about it. So we're looking at that 85% growth of the market that is not digitized in the country, and when the pricing pressure on some of the existing accounts and others will continue and will let them fight and burn. Our whole aim is that to get strategic good accounts in with our platform plus payment strategy, plus our wider offerings with BBPS, Bharat Bill Payment Systems, the Bill Avenue Solution, Hospitality Solution, Res Avenue, our platform play, and others. And then on the payments play, there is a lot of growth. We are onboarding thousands of merchants every month, and the business and the volume continues. So payment is a very generic business. What is commerce? Commerce is any goods or services sold and payments made. So we want to be there every time when that payments is being made. So we have to keep growing that, create new tools, new systems and new things, and the growth will continue. So even if you've seen, despite the pricing pressure, and it's not something new, It's been there for the last 4 years, right? And it will continue growing. As far as PayPal is leaving the country, PayPal could not adapt to the country's rules, most probably, because the way they do their P2P business in US, which is following our central bank's prepaid instrument PPI guidelines, it's quite different and not the way they want to go. And maybe perhaps that they must have taken call and maybe focus only on cross-border transactions from abroad. So that's the thing. So as I said, look at the broader picture, look at the 85% market that is there, and we have been consistently growing despite whatever the pricing pressure, and we continue to remain profitable.
I'm at no point of time questioning the opportunity that exists. I completely agree with you that we are hardly 15% into the digital mode, and then 85% still remains. I was only trying to figure it out now with some of the players who have come in, who have been pretty aggressive. They must have been burning. And to what extent do you think that they will burn? It's a question that affects you too, and invariably gets into a margin pressure. Even some investors ask, why is the pressure on the margin? So I was trying to understand that particular part. Now, the other part that I want to ask is, how many of staff that we have? Because we are more of a product company, effectively. It's not a time and material. So when it's not a time and material part of it, you are moving now yourself into various other markets. You've gone into the Middle East and you're growing up in almost all these kind of places. So how much is going to be your addition of number of people that you require? Except I would presume more from the marketing part of it.
Okay, let me take this question. On both the verticals, payment verticals and platform verticals. In the platform verticals, we are a hardcore product company, and we offer actually on it's a SaaS, and we offer on a cloud model. It's basically a hardcore product company. In fact, some of the contracts actually permit us to do the overall system integration work, overall application management services work, overall application development services work, and we actually refuse. So we are a product company, and we license actually our products and services, and we do support, maintain, and manage the services. But some of these typical services business, we actually stay away. So that is the reason why our revenues are not linear to the cost, and it's not linear to the headcount. So in that sense, our margin percentage actually on the platform is definitely one of our growth driver actually for our bottom line. So having said that, in our platform, in our payment business, roughly 95% of our payment business is transaction driven at the end of the day. So the fixed fee business is there, and that is also growing, but by and large, it is actually transaction driven. So therefore, for all practical purposes, it has nothing to do with the headcounts in any manner, even though we are calling it as a payment services or payment gateway services and so on and so forth. So therefore, the margin pressure which you talked about earlier, the margin pressures and pricing pressure is definitely the art of pressure is always there. And that is what we are managing it actually day in and day out actually with our different rate cards and so on and so forth. So I think, our number speaks itself. I think we have grown. The previous question asked by Devan also that, we have grown actually quarter on quarter in terms of TPV value. In first quarter, the same pressure was also there. 18,000 crores actually we processed. Q2 we processed 30,000 crores. Q3 we processed 39,000 crores. Q4 we processed 50,000 crores. Totally is about 1,39,000 crores at the end of the day. And vis-a-vis 878,000 crores actually in FY20, resulting actually 60%, experiencing 60% growth actually on a Y-on-Y basis. At the end of the day, that the run rate which Vishal Bhai was talking about, the run rate of 28 billion, is based on our payments and platform business run rate, and we believe that we will be able to grow. That is a unified model which we are having, because platform is linked to the GEM transactions and Geo transactions actually, even though Geo business model is license fee, but it's largely driven by GEM transactions. And on the payment side, we have a conventional PG, front-end PG for the merchants, and we have CPG new offerings. We have neo banking actually as a profit driver, and we have a white label business and the B2B business actually as well, besides our bill revenues and the revenue platform. Now we strongly believe that the COVID situation is very temporary. The moment COVID situation improves, obviously that the 4 flagship sectors of us will get actually open, and we will have a different margins altogether. Considering all these things only, we have guided the market actually in terms of EBITDA margin.
Srikanth, somewhere I think you mentioned that probably you are targeting from 19 billion that we have done in FY21, probably going towards 28 billion, correct?
No. The present run rate actually on the payment business is about 18 billion, and on our platform business is about 12-13 billion. Total run rate is about 28 billion. So
Okay.
the 28 billion run rate will possibly will grow actually. So that is why that gives the confidence to us that we will do 100 billion in 3 to 5 years time.
Okay, perfect. I'm no point of time questioning, because if I look at your competitors like Razorpay or etc., the kind of people who have backed it out, the kind of number of times that they have raised money, obviously that is where they got money to burn to that extent.
Right. Thank you.
Thank you. The next question is from the line of Unnati Bavekar from KR Choksey. Please go ahead.
Good evening, everyone. Yeah. So my question is that you've been carving out payments transaction process overall, and then bill payments process volumes, which is a subset of that overall, which is a part of that Bharat bill payment system. And you've also been talking about GEM transaction process. So will it be apt to believe that the overall payments GTV is going to be driven by the growth in the Bharat bill payment system for the short term now, given that rest of the e-commerce transactions could have been affected due to lockdowns with discretionary spending being held back?
Hi, this is Vishal here. So that was definitely the case in Q4 of last year. We see a lot of, this quarter also we've continuously seen okay and good growth. We don't see a dip in transaction volumes. We expect that maybe by end of this quarter, early next quarter, that when COVID settles down, that will open up quite a bit. Short term is a relative term, but we think that it potentially does not go beyond this quarter.
Okay. And you've been mentioning about the fact that the express lending services that you've been offering to the merchants, that has been quite a margin-accretive proposition for you. So without the new banking license, how is this lending happening? Or it could be a layman kind of a question from my side, but that is there. And then again, or is it a part of the operating credit that you extend to the merchants?
No. Let me explain on this. Actually, it does not require a operating banking license and so on. So express settlement means that, as per our normal conventional payment processing business as a front-end PG actually for the merchants. So under the regulations, under RBI norms, we have, depending upon the merchants, so we have T+3, T+5, T+7 settlements as the case may be. So that is a allowed one. Now, today, the merchants are all wants actually money on the same day. So therefore, we have an ability to really settle the transactions actually on the same day. And therefore, since we are truncating it actually by a few days in advance, so we are charging something extra actually to them. And that is what we call it as express settlement. So in the process that, this is after the success of the transaction, therefore the NPA is practically zero. And for all practical purpose that, we charge something higher, and that is why we are saying this is like a profit driver actually for the company.
Okay. Yeah, thank you very much.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments.
Thank you all for joining our Q4 and full year earnings call. Hope you are all safe and your family is safe, and we look forward to speaking to you again shortly whenever we updates. Thanks again.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of Infibeam Avenue Limited and KR Choksey Research, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.